Good morning. This is Jason Dahl with AFS Financial Group. I'm excited to lead today's presentation on financial planning essentials. So thank you for joining us. We anticipate that we're going to keep today's webinar to right around 45 minutes. Try not to go too long, but we do have a lot of great information to share. So let's, without further ado, we'll go ahead and get started. I also want to mention that this is being recorded, so we will follow up and send a recording that will include the slides and the audio that will probably get sent out tomorrow or Monday. And then I also want to mention that you can ask questions during today's webinar. So at the bottom of your screen, there should be a little icon that says there's a chat icon. That's the one that I would recommend you use. So if you want to type in a question, click that chat box. It opens up a little screen where you can type in a question, and we'll keep an eye out for those to address during today's call. So without further ado, we are here today to give you an overview of what we call financial planning. And our goal with today's presentation is to provide you with tools to make wise financial decisions and to achieve greater peace of mind in your financial life. And the underlying theme throughout today's presentation is to take action. Now, I guarantee, and I realize that's a dangerous word in our business, but I do guarantee you that for each and every person tuning in today, there's going to be at least one item, probably more, but at least one item that you can take away and do something with to improve your own financial plan. I also like to note that when we go through a complete financial planning process with a client, that is typically probably an 8 to 12-hour process. So obviously, we're not able to help everyone on today's call with their personal financial plan, but I guarantee you that you will come out of here today with at least one nugget that you can apply in your life. And not only can you ask questions during today's call, but as a follow-up, we definitely encourage folks, if there's something that we talk about today that kind of sparks your interest and you want to follow up afterwards, please reach out to me or the folks on our team. We'll have everyone's contact info later in the presentation. All right. So in honor of National Financial Literacy Month, beginning on Monday, we are hosting this webinar to hopefully demystify the often bewildering term that is financial planning. So I always like to ask folks right up front to take a moment and think about what comes to mind when you hear the term financial planning. So not only what words or topics you think of, but also what emotions the term stirs up. Does the idea of your financial planning excite you, scare you, bore you? I presume it does something for you, otherwise you wouldn't be joining us today. But it's funny, it seems that most people spend more time planning their vacations than they do mapping out their own finances. And in reality, we can't take those vacations without the financial resources to do so. So as I mentioned, we're going to start by kind of defining financial planning and then really diving into what we consider the four most sort of prominent components of financial planning, starting with retirement planning, followed by education planning, personal risk management and insurance, and we'll wrap up with estate planning. So for me, if there's one word that I think of when I think of financial planning, it's process. It's not a one and done. It's not something you do and then have a big document that says, hey, here's my financial plan, we're all set. Because life happens, right? Life evolves, things change, and it's something that definitely requires constant review and vigilance and updating. And so what you see here on the screen is sort of a basic the basic components of that process, right? Thinking about what's important to you. What are your goals in the near term, medium term, long term? Obviously, you need to kind of assess, all right, well, what's your current situation? What's your current income levels and assets, liabilities, right? All those sorts of things. And then start to identify some realistic strategies. And then you got to put things into action, right? That's probably the most important step of it all. And then periodic monitoring and repeating. And then one of the other important questions to think about is, can you do your own financial planning. So while many people can and do handle their own financial planning and do a fine job of it, I will say that many people, they may say that they're handling their own finances, but in reality, they are merely, to use a popular Washington, D.C. term, kicking the can down the road. And so alternatively, many folks will decide to work with a professional financial planner, right? Somebody who's working in your best interest to focus on your financial plan. So probably the planning topic that causes the most anxiety or even excitement, I'll say, is retirement planning. And that's because none of us want to work forever. I presume, well, maybe there's some folks out there that want to work forever, but most folks would like to, as I like to say, make work optional, right? And there's many studies out there that will survey folks and ask them. And in fact, just today on my metro ride into the office, I read another article that was surveying folks and their advisors. You know, what's the thing that worries them the most in their financial plan? And right at the top again was the fear of running out of money. So as you see here on our screen, the way we kind of define the goal of a retirement plan is to provide enough income to maintain your standard of living for the rest of your life, and here's the important part, regardless of how long you live. And so I always kind of joke that while your doctor is afraid of you dying too soon, we, as your financial advisor, we also worry about you, but we're afraid of you living too long. So probably the one question I get asked more than any other is, well, Jason, can I retire? And the answer is always yes, but it all depends on how much you want to spend or how much your lifestyle is going to cost, right, once you are retired. And so really the first and most important kind of step to go through is thinking about how much your life today costs, because that is going to really inform how much your life in retirement is going to cost, right? Now, obviously, it's not a perfect apples to apples because things will change once you're in retirement. We're going to talk about that in more detail, but it really is an excellent starting point. And so this screen, we've sort of outlined a really great, quick, back-of-the-envelope way to estimate how much money you're going to need in retirement based on what you currently earn. And so you see there right at the top, you take your gross pre-retirement income, your total household income, and then you subtract out what you pay in payroll taxes, and then you subtract out what you are saving for retirement. Okay, so let's talk about that a little bit more. So your payroll taxes, of course, consist of two components. There is the 6.2% Social Security tax and the 1.45% Medicare tax. And so we don't pay those payroll taxes on retirement income, so that will go away. And then obviously, once you're in retirement, you're no longer going to be saving for retirement, right? So if we back those two numbers out, essentially what's left is your estimated post-retirement income needs, right? Because if you're not paying it in payroll taxes and you're not saving it for retirement, what else are you doing with it? You're spending it, right? And included in those expenses, of course, is paying Uncle Sam, right, or your taxes. And so we just have a few examples down below where you have a household income. If we start there in the middle for a moment, right? If total pre-retirement household income is $120,000, you subtract out the payroll taxes, you subtract out, in that case, just a 10% savings rate, and the current annual spending, taxes included, is right around $98,000, $99,000. And we, in each example here, it perfectly comes out to a spending percentage of 82%, and surprisingly enough, it oftentimes comes out to right around 80%. But it obviously will vary depending on your situation. And just kind of a quick note there on the asterisk related to payroll taxes. So if your pre-retirement income was above the wage base, so for 2019, the 6.2% of Social Security tax was capped, and so it only applied to the first $132,900. So as you see there in the example where if someone was earning $150,000, then that 6.2% only applied to the first $132,900. But the Medicare tax applies to all wages. So this is, I imagine some of you, because I've presented this many times, and we'll always see folks pulling out a notepad or literally a back of an envelope and start sketching this out to kind of get an idea of, oh, well, how much does my life cost now? So now let's talk about the other side of the retirement equation, right? So we just talked about sort of how much are you going to need. So now let's talk about the sources of retirement income to fill that need. So some of you may be familiar with the old three-legged stool analogy for retirement, the three legs being Social Security, a pension, and your personal savings. So for many folks, it's really become a two-legged stool as pensions have been going away. Now, here in the DC area, we still see pensions at a higher propensity than kind of the national average, as you can imagine, with more federal employees around here. But there's a lot of state pensions and still some private pensions out there. But for today's conversation, we're really going to focus primarily on Social Security and your personal savings. And just a quick aside, right? There may be other sources of income in retirement for some folks. Like you may have some rental properties that you have income coming in, or maybe you're saying, I'm going to work part-time or do some consulting in retirement, right? So everybody's situation is different. You would obviously take those into account. But like I said, within the confines of today's presentation, we're going to focus on Social Security and personal savings. All right, so when it comes to your personal savings, one of the more challenging components when it comes to your retirement plan is saying, okay, if I've saved, I've worked many years, put money away in my 401k and my IRA and our personal investment accounts, right? It's a big transition to go from making money and saving money to now no longer making money and now spending money, right? Drawing money out of your account. And so this slide here kind of talks about sort of a rule of thumb or a great way to kind of estimate, all right, how much could I reasonably expect to live on from my personal savings without fear of running out of money in retirement, right? So getting back to that, because we don't really know how long you're going to live. And so you have to kind of be conservative, but obviously, you want to live for today, but save and be mindful of tomorrow. So on this slide, some of you may have heard this term before, a safe withdrawal rate, or there is oftentimes something that gets called the 4% rule. And so let's talk about what that means as we walk through this slide. So in this case, we have an example here where the total savings, so you see the total liquid assets there of $900,000. Right? So that could be, again, a combination of 401k balances, IRA balances, and personal savings. And if somebody's still working and still savings, right, you're projecting that number, right? So you want to look out and say, okay, if I continue to save at my current rate and use a reasonable expectation for growth, or if you're in retirement now, you may say, hey, this is what we have saved. Okay, so in this example, it's $900,000. And so then you get to the safe withdrawal rate or the 4% rule. And so that 4% is something that there's been a lot of research and study that's basically gone in to say how much could someone withdraw out of their total assets their first year of retirement with an expectation of a 30-year retirement window, okay, without fear of running out of money. So the 4% really just establishes kind of the baseline or the initial withdrawal amount. So 4% of $900,000, so that first year you would take out $36,000. So that establishes your base. Then in subsequent years, you basically give yourself a cost of living adjustment. So that $36,000 in year one turns into $37,620 that you draw out in year two, assuming a 4.5% cost of living adjustment. So that's the inflation rate that we use in our office when we run the projections. I realize that historically the long-term rate of inflation has been lower than that, closer to maybe 3.5%. But again, we try to err on the side of being conservative when making these projections, but we also think there's a reasonably strong argument to say that, hey, over the long term going forward, inflation could pick up. But that conversation's for another day. All right, so now let's talk about Social Security, right? So one of the things I want to encourage folks to do, if you've never done this, is to go to the Social Security website. So it's easy. It's just ssa.gov and create an account. They're going to ask you some background questions to confirm you are who you say you are, and then you can look up your Social Security benefit information. It not only shows you what you're projected to receive in benefits, but it also gives you a history of all your earnings. And so let's kind of talk about how your Social Security benefits are calculated, and we'll spend just a couple minutes here on thinking about how to best utilize it. But I do want to note, it's always important here that we actually have two separate presentations, and I imagine some of you have probably heard them or participated in them, that is just on Social Security. And so today we just have two slides. So we really are just kind of touching on the surface, the very most important kind of topics of Social Security. So first I want to also add that despite the many dire reports, Social Security remains an important component of retirement. I think it's important to debunk the sort of fear that Social Security is going away and it's not going to be there. And again, we can talk about that in more detail, sort of why we feel strongly about that. But we plan on Social Security. I'm 42 years old. I expect to get Social Security someday, but I do expect the rules to be different. So first off, Social Security benefits are based on what is referred to as your full retirement age, or FRA. So as you can see here on the screen, your full retirement age depends on your year of birth. So it's either 66 or somewhere between 66 and 67. So if you're born between 1955 and 1959, it actually goes up in 2-month increments until anyone born 1960 or later, full retirement age is 67. Now, that is one of the things that I fully expect them to change. So I don't expect it to be 67. It's going to be pushed back for me at some point. And then everything the Social Security Administration does is kind of anchored to that full retirement age. So they say, okay, what benefit are you expected to receive at your age, 66 or 67? And then if you file early, and you can file as early as age 62, they're going to reduce that benefit. Alternatively, if you delay benefits to as late as age 70, and there's no benefit beyond age 70, so that's really the latest you can wait to start Social Security, you will receive what are called delayed retirement credits of 8% per year. So this chart, I think, does a nice job of sort of outlining how valuable Social Security can be, as well as you sort of planting an important seed in your mind that there's a lot more to Social Security than just, hey, do I take it at 62 or 66 or 70, right? Because most folks may qualify for benefits from multiple sort of pools of assets. The traditional way, of course, is just based on your own work record, which is you qualify for Social Security after having worked 10 years and earned 40 credits, but then your benefit is actually calculated based on your highest 35 years of earnings. But then a lot of people may also qualify for a benefit based on a spouse or ex-spouse's work record. And separately from that, as a survivor or widow or widower, folks may qualify for an additional benefit there. And so these are all the kinds of things that we help clients think through to make sure, hey, what's the most strategic decision to make, because everybody's situation is a little different. So now let me back up and walk through what we're looking at here on this slide. So this is an excellent representation of how, when you begin your benefits, impacts the amount you receive. For example, in this case, we've said full retirement age is 66, and the benefit projected is $2,000 a month at that full retirement age. As I said, if you file early, it's going to be reduced. So it would be reduced to $1,500 a month. So let's just kind of establish that as our baseline to say, hey, that's the earliest I could file, and I'm eligible to receive $1,500 a month. So that's where you sort of see that zero baseline there. Then you have at age 63, if you wait a year, that benefit's going to go up 7%. And then if you wait 2 years, it's 15% higher, and so on, to where if somebody waits all the way to 70, that benefit is 76% higher. And now that doesn't even take into account any cost of living adjustments that may apply along the way, and if somebody's still working and adding to their benefits. So there's really kind of three components getting added there: the delayed retirement credits, the cost of living adjustments, and if you're continuing to work and increase your benefit. All right. So just a few quick tips when it comes to saving. Right. This is your Social Security really is kind of, you don't really have much control over that, right? While you're still working, it is what it is, but while we are working, we have a lot of control over how much we save. So one of the best tips I can share is when you pay off a debt, whether it be a student loan, a car loan, a home equity line of credit, a mortgage, you name it, right? That money that you had been paying towards that debt payment, right? You're already accustomed to not living on it, right? Not spending it. So I always like to say, maybe take 1 month and celebrate, and then immediately divert that money that you had been paying towards the debt and increase your savings, right? And in addition to that, every year, maybe even every 6 months, look to see if you can bump up your savings by 2 or 3%, right? So if you say, gosh, my target is I want to be putting away 15% of my income towards my 401k account, for example. But right now, everything I can do, I can just get 10% in. Well, come the start of the year, or come mid-year, so I'm going to bump that up 1% or 2%, because take it in little bites, and you won't necessarily feel it, hit your bottom line each month as hard. Act like a business, and periodically, be your own personal CFO, right? And look at your expenses, and because we're all guilty of sort of lifestyle creep, or there's just monthly payments that we signed up for, and you realize, oh gosh, I don't really get any more get any value out of that subscription anymore, right? And just kind of cut those expenses and increase your savings. As we like to say in our office, that no one has ever complained about having too much money saved for retirement. We've already kind of mentioned a few of these items, right? So the sort of vehicles for how you can save: your 401k, right, sponsored through your employer. Now, for some folks, that could be a 403b or a 457, right, depending on the structure of your employer. But they're basically all the same thing, right? It's an employer-sponsored retirement plan, and in 2019, the maximum amount you can contribute is $19,000. All right, and that's a great goal to aim. Say, hey, I want to max fund my 401k. And then if you're age 50 or above, you can put an additional, what they call a catch-up contribution. So you can do an additional $6,000 for a total of $25,000. Now you could also save in an IRA, a Roth IRA, or build up your own personal savings. Now, if you have questions about, am I eligible to also contribute to an IRA based on my income? These are all kinds of questions that we can help you sort of look at in your own personal situation. So feel free to reach back out to us. And just kind of a quick note sort of on the difference between a Roth or a traditional IRA. And there's also now a lot of 401k plans will offer Roth options within the 401k. And so some of you may already be aware, but when you make a contribution to the traditional 401k or traditional IRA, that money goes in pre-tax, right? So in essence, you're getting a deduction up front, and then the money grows tax deferred while it's inside the IRA or 401k. But then someday in the future, when you're in retirement and you're drawing the money out of the account, that money is going to be taxable. Whereas on the flip side, a Roth IRA or Roth 401k is kind of just the opposite. you do not get a deduction up front. The money you put in goes in after tax. It also grows tax deferred, but then someday in retirement when you take the money out, it will come out tax-free. So what's right for you all kind of depends on your situation, but kind of a good rule of thumb is to think about while you're young and maybe in just starting out and your income is lower than it's going to be, right, as you progress in your career, you may say, hey, I want to contribute to the Roth, right? And that's exactly what I did, for example. For many years when I first started out in my career, I did 100% Roth contribution. And then as I progressed and I went into higher tax brackets and my wife and I made more money, I started to split it, do some pre-tax contributions and some after-tax Roth contributions. And then now I've gotten to the point where I do all pre-tax contributions because I think it's more valuable to get the pre-tax deduction now. All right, so just kind of, this isn't real rocket science here, but it's a good, easy way to just sort of estimate, all right, well, if I go to the Social Security website and look up what benefit I'm projected to receive, and then I apply the 4% rule to the money I expect to have saved for retirement, and I add those two numbers together, and then if I'm going to have a pension someday, add that number to it. If I expect to have, rental income from property someday, add that to it, right? And then you come up with, all right, this is how much I'm projected to have an income in retirement, and then compare that to the first notes that you took down when you were estimating how much your life costs, and see, hey, are these two numbers relatively close to one another, or am I, a little short for being able to replace the income I want to have in retirement, right? And so now it's a great way to say, all right, well, what kind of mid-course adjustments can I make? Can I save a little bit more? Can I cut some expenses? Maybe I need to work a little longer, right? All those sorts of things go into really having a robust financial plan. All right, so let's shift gears to college funding or education planning. Now, if there's one word that I always think of when I think of saving for college, is that college is expensive. It doesn't seem to matter what state, what university, what college, it's expensive. And it just kind of blows my mind that it just keeps going up without exception every year, 5, 6, 7% increases to the cost of college. And I'm trying to my wife and I are trying to do the best we can. We have a 7-year-old and a 2.5-year-old to try to save, but when I look at the projected dollar amounts, it's just, you want to bury your head in the sand. But it is important to save and start early. And so this slide just kind of gives you a representation, sort of national averages for the cost of in-state tuition, out-of-state, and private colleges. One of the things I'm a big advocate of is have a conversation with your student, your child, if they get old enough, and help them to understand that an important variable when looking at what college to choose is cost, right? And it's a great learning opportunity to help them sort of understand that things cost money, and you can help educate your kids on how you're going to pay for college. All right, and one of the best ways to save for college, probably the most common at this point, are 529 college savings plans. Now here in this area, of course, in the DC, Maryland, Virginia area, or as the DMV, as I like to say, there are basically two kinds of plans, and each state offers each of these plans. There's just sort of all called the traditional sort of savings plan, and then there's a prepaid plan. And actually, the prepaid plans are becoming more popular, especially as a more conservative investment alternative. And then just a quick note that we really don't see much anymore the use of custodial accounts or UTMA accounts or the old Coverdell education savings accounts. So there's still some of those out there, but for the most part, we're really focused on the 529 savings plans or the 529 prepaid plans. And so just kind of a quick comment on the prepaid plans. So basically what you're doing there is each state looks at, kind of the average cost of attendance at the state universities, and then they say, okay, you're locking in the cost of attendance in today's dollars by putting money into the prepaid plan. So, if I wanted to buy a prepaid plan for my 7-year-old son, I'm basically saying, all right, so roughly 11 years from now, I'm paying for the cost of attendance today, but in 11 years from now, I've essentially made my investment based on the future inflated cost. And so that's where it can be a relatively more conservative way of saving for college relative to these savings plans, right? And so let's talk about them for a moment. And these really work similar to your 401k plan, right, where you have a lineup of available investment choices, and you can pick, you could be an aggressive investor, you can be a conservative investor, right, a moderate, anywhere in there. And there's also what are considered target date funds, where you say, hey, my child is projected to start retirement in 2030. That you could pick a 2030 fund, and it kind of does it for you. It periodically will become more conservative as you get closer to that target date. And contributions to 529 plans may be deductible depending on your state. The earnings will grow tax-free, and the withdrawals will come out tax-free so long as they're used for qualified education expenses. And now one other quick tip is if you have a child who's currently in college, don't forget there's a simple trick you can use by contributing to your state's 529 plan before you make the tuition payment, right? So rather than just writing a check directly to the university, you want to open and fund the 529 account to take advantage of the state tax deduction and then pay the tuition bill out of the 529 plan. So let's just talk a little bit about those deductions. So we're going to just give the example of Maryland, DC, and Virginia. So in Maryland, the Maryland College Savings Plan allows up to a $2,500 per beneficiary per year deduction on your state income taxes. So that's per year by an individual, and up to $5,000 per beneficiary per year by married taxpayers who each make contributions to their own accounts. And if you put in an amount above that, there's actually a 10-year carry forward of excess contributions to continue to receive that deduction. Now in DC, the deduction is up to $4,000 per year by an individual and up to $8,000 per year by married taxpayers who each make contributions to their own accounts. And in DC, there is a 5-year carry forward of excess contributions. And in Virginia, it's up to $4,000 per year per account with an unlimited carry forward of excess contributions. And the contributions, well, there's a funny rule in Virginia where contributions are fully deductible in the year of contribution if the taxpayer is at least age 70 and above. So if you're a grandparent putting money in, you can get an unlimited state tax deduction. All right. Let's see, did we have a question? Oh yeah, we actually did have a question come in about funding for grandchildren's college costs. So if you're in Virginia, you can get a great state tax deduction, as we just talked about, if you're age 70 and above. But one of the things that we encourage grandparents to do is, and parents, right, is to talk to the grandparents and say, hey, what would be an awesome gift for the grandkids is to open and fund 529 accounts for them, right? That's something that they're really going to, they may not recognize, the value of it today, but definitely when they get to college, they're going to look at that and say, wow, grandma and grandpa really helped out by putting money in a 529 account. In today's world of just, too much stuff, I'll say that there's so many presents of toys or whatnot that the 529 funding can be just a phenomenal tool. And keep in mind, that if a grandparent or a parent, right, anyone who opens the 529 account, you are the owner of that account, and then you name a beneficiary on the account. So if, for example, one of the grandkids doesn't go to college or gets a full scholarship, you could always change the beneficiary to another grandchild or to a niece or nephew or great grandchild, etc. So you retain ownership of the 529 account. All right, so let's talk for a moment about everybody's favorite topic of insurance or risk management. So, of course, insurance really is just a great tool used to transfer risk to an insurance company, right? And like sort of the theme to today's presentation, it's really important to periodically review your various insurance coverages. Every year or so, or definitely whenever you have an important change in your life, right? So if there's an addition to the family, if somebody changes jobs and gets a raise, divorce, marriage, right? Any of those sorts of things ought to be a good trigger to say, hey, I should probably review and make sure insurance coverages are appropriate. All right. In some instances, that may mean getting additional coverage, and other instances, it may mean, hey, saying I don't need this coverage anymore. All right. So let's talk about life insurance. Right. So life insurance is most commonly used to protect against the loss of current and future income if something was to happen to you or a spouse during your working years. And a common guideline when thinking about how much life insurance you need is you can just do a quick rule of thumb to say, look at what is 75% of your prior income upon the death of a spouse, right? So if somebody's income is $100,000 a year, you may say, all right, we would need to replace $75,000 a year if that person were to pass away, and then you sort of multiply that by the number of years you expect to keep working. All right, so if you're looking at, hey, I want to be retired by age 66 or 67, right? You just do a quick math of how many years that is by the amount of income that would need to be replaced. Now, in addition to the income replacement, a lot of times folks say, well, I also want to account for paying off of a mortgage or any other debts, right? So you may say, all right, add to that the mortgage balance. And then the third component that a lot of times folks will think about, as we were just talking about, right, is saving for college. Is if you say, hey, we've been putting money away for college, but then if something were to happen to you or your spouse, could the surviving spouse continue to save at the rate that you wanted to for college? And if that would be a difficulty, then you might say, hey, I want to account for that there's going to be enough life insurance proceeds to help save for college as well. All right, so those really are kind of the three biggest variables: is replacing lost income, paying off debts, and any education funding targets. And there are many free life insurance needs tools online, but ultimately it really is something you want to sit down with someone who's an experienced insurance professional to sort of look at not only what your need is based on your financial plan, but also understanding the many different types of life insurance. So let's talk a moment about that, because there really is just myriad different life insurance policies. But ultimately, that really kind of breaks down into one of two categories. There is permanent life insurance, and there is temporary life insurance or term life insurance. And so permanent is just like it sounds. It's life insurance you're getting in place where you're saying, hey, regardless of how long I live, there's going to be a death benefit that's going to pay out when I die. Whereas term life insurance, think about it as kind of like renting the life insurance. As you're saying, hey, I want to have the coverage in place for a period of time. Most often it's from now until when you're going to retire, right? That's probably the most common use. So you might say, oh, I'm going to be working another 30 years, another 20 years, another 15 years, another 10 years, right? And so there are term policies you can get for all those different time periods. Term life insurance is generally going to be the lowest cost form of life insurance because really, like I said, you're just renting it. You're just paying for the coverage, the peace of mind to say, hey, if something happens to me or my spouse, the survivor is going to be protected and receive the death benefit. Whereas permanent life insurance is going to be more expensive for a couple reasons. One, because it's there. It's going to be there no matter how long you live. And then two, a lot of permanent insurance policies also have kind of a savings component to it, or a cash value. So each year when you pay the premium, a portion of the premium is to pay the cost of the insurance itself, but then also a portion of it's going into a savings account. And there's where you really open up a whole another universe of different kinds of life insurance policies. You have whole life, you have universal life, you have variable universal life, you have equity indexed universal life, you have guaranteed universal life. It really is almost endless, the different kinds of permanent life insurance policies. And there really is no right or wrong answer that one type fits all. It really depends on the person. But probably the most important thing I can say is that when looking at life insurance, make sure you're covering the most important issue, and that is the death benefit, right? Make sure you have enough coverage in place to replace that lost income, pay off the debts, right, so that the survivor is protected. And so for a lot of folks, that may mean, hey, all we can afford is the term policy. And so make sure you get the right amount of coverage in place through term, and then maybe you supplement it with a permanent policy. But again, that's something that's worth really reviewing your full financial plan, talking to your your financial advisor, and that's obviously something that we help clients with, to make sure you have the right types and amounts of coverage. And as you can imagine, sometimes when you get into retirement, you may say, oh, maybe we don't need the same amount of coverage anymore, and you can reduce or eliminate. But you never want to get rid of a policy until you've really thought through what's your health, right? And is it right for your financial plan? All right, so let's talk a little bit about disability insurance. Similar to life insurance, but an important difference here, right, is basically if you or your spouse are unable to work and income is lost because of a disability, right? So some people may even argue that this is more important than life insurance. I don't know that it's more important or equally important, but because if you think about it, if someone dies and the income is gone, well, that person is also gone, or they're no longer an expense, right? Whereas if someone is disabled and their income is lost, they're still around and are an expense. So I realize that's a little bit of a crass way of thinking about it, but just from a financial perspective, it was really important to make sure that you have proper disability coverage in force, right? So there's short-term coverage that basically says, hey, you got into an accident riding your bike or water skiing, right? And you're unable to work for, a month or 3 months, 6 months, right? But you're going to get better. You're going to get back to work, right? So that's where the short-term disability comes in. Then there's a long-term disability that says, wow, something has happened where you're unable to go back to work, period. And there's different policies that say your own occupation or any occupation, right? So you're unable to go back and do your own occupation, but you could go out and do something else, or you're unable to do any occupation, right? So that's an important distinction when you're looking at your disability policy. And then keep in mind that the coverage generally will only replace up to 60% of your income, right? So it's not going to replace 100% of that lost income. And then another important thing to look at is, do you pay for the premium or does your employer pay for the premium, right? We've probably all seen where, right, there's employer-paid disability coverage. And if your employer pays the premium, then any benefit you receive if you become disabled is going to be taxable. But if you pay the premium, any benefit you receive will be not taxable. And so that's an important thing to keep in mind, because a lot of people will say, hey, I have coverage through my work, but maybe that's not enough, and I want to supplement it, especially when you consider that it's going to be taxed. If the employer benefit, you may say, hey, I'm going to go out and get some coverage on my own and pay the premium myself to make sure I have the right amount of coverage in place. All right, so let's just spend a couple minutes on long-term care insurance. So the main question behind long-term care insurance is who or what pays for long-term care, right? So think of long-term care as either someone coming into your home to help help you, maybe going to an assisted living facility or a nursing home. So for a lot of folks around this country, the reality is that any care is going to be provided by a loved one, right? Just out of their blood, sweat, and tears. However, folks will also get an insurance policy to help, right, hedge that risk, to say, hey, if I need someone to come into my home, or if I end up in a nursing home, I want to, spread that risk out to have the insurance company help pay for that cost. Now, one of the most common questions we get is, well, won't Medicare pay for long-term care insurance? Or pay for long-term care, excuse me? And the answer is, and this is important to remember, is no. Just end of story. Medicare does not pay for long-term care. Medicare is health insurance, where long-term care is custodial or maintenance care. Basically, it's when a doctor says, hey, you're no longer expected to get better, right? And that could be a cognitive impairment like Alzheimer's, dementia, or it could be a physical ailment, right? It could be due to a stroke. It could be from severe arthritis, osteoporosis, right? There are any number of things where you might just say, hey, you're no longer expected to get better. That's no longer health care. That is now custodial care. So Medicare, right, which is health insurance for retirees, does not pay for long-term care. But then you may say, oh, but Medicaid does, right? So Medicaid, of course, is different than Medicare. So yes, Medicaid does pay for long-term care insurance, but to qualify for Medicaid, you essentially have to have zero assets and all your income has to be going towards the cost of your care. So the reality is that Medicaid is not a realistic option for a lot of folks. And so you really have to think about, how am I going to pay for this myself? Out of my own income, my own savings, or with an insurance policy. And that's the thing that we always talk about with clients. The most important thing is to have a plan in place to hedge that risk, to say, hey, what if this happens? Then what's our plan? And for some folks, that is through the use of an insurance policy, but not always. Because the cost of care is expensive. And it can depend on where you live, right? So I'm sure you recognize that if it's inside of a beltway, right, close to a major metropolitan area, it's going to be more expensive than if you're in a rural area. But then it also depends, right? So if someone's just coming to your home, maybe part-time, a few hours a day, to just help maybe with the bathing or making meals, that sort of thing, that's going to be lower cost than at the other end of the spectrum if you're in a full-time private room in a nursing home. Obviously, that's going to be much more expensive. So there really is a range here. And this on the screen here just kind of gives you a sense for that range of cost. This is just kind of for the DC metropolitan area. And last but not least is your liability coverage, right? Everybody's familiar with having your homeowner's policy and your auto policy, but the one that oftentimes gets overlooked is the umbrella policy. And just like the name implies, it's additional coverage above and beyond your homeowners and auto coverage. So we always like to sort of give the example, and I realize this is getting a little out of date now, but way back when Michael Jordan played for the Wizards here in town, if you got into a car accident and you injured Michael Jordan and he was unable to play basketball anymore, your auto policy is going to write him a check for $350,000, $500,000, right, whatever your limit was. And then all the additional liability is going to come out of you. And that's where having an umbrella policy helps protect you, right? Typically, you're looking at additional coverage of $1 million, $2 million, $5 million of protection. And it's relatively inexpensive. It's just maybe a few $100s a year, but it is more expensive, of course, if you have kids who are still on your policy, right? So if you have a 17-year-old boy in particular, not only is your auto policy going to be more expensive, but your umbrella policy will be more expensive. But it is an important piece, especially if you say, hey, we've worked hard, we've saved money, we've got a lot of assets to protect. You would hate to put that at risk from an accident at your home or in your car. And that's where reviewing this with your agent who does your home and auto policy is an important piece. All right, we're going to wrap things up here with estate planning. And probably the most common misconceptions when people think about estate planning is that it only applies to the very rich. However, this could not be further from the truth. Estate planning is for everyone. For example, a will is a part of estate planning, and everyone should have one of those. It's important to inform your family of what planning you have done, where your estate documents are, and who is appointed to do what for you. So in addition to a will, the other basic documents are your powers of attorney, right? So you want to have a healthcare power of attorney and a general financial power of attorney. Oftentimes, folks will name their spouse, right, to fill that role. And then you want to look at, hey, who's the successor? Sometimes it's an adult child. Sometimes it's a sibling. Sometimes it's a trusted friend. One thing you want to keep in mind is, if possible, you would like that person to be someone who's younger than you, for kind of obvious reasons. But like I said, let that person know that you've named them. We've run into instances where someone has said, oh yeah, I named my kids, but then when the kids found out, they're like, I don't feel comfortable with that, right? So have a conversation. Let them know, hey, I'm considering naming you to make healthcare related decisions for me if I'm incapacitated and unable to make decisions. Another common question we receive is, should I have a trust? And the answer is that it depends on your specific situation. Trusts are not quite as relevant from a federal estate tax perspective as they used to be. However, trusts do still serve a valuable purpose for many people. A trust can potentially protect you or your loved ones from themselves, creditors, and the parties involved in a divorce. Trusts are also helpful in second marriages, especially if there are kids from the prior marriages. And then another question that actually just came in is should we work with an estate attorney, or there are a lot of the online tools like a LegalZoom. And the right answer really is you should sit down with an estate attorney. However, for some instances, and real basic estate documents, if someone's young, maybe not even married, you just say, hey, I want to make sure I have my will and a power of attorney in place. If there's no kids, that sort of thing, a LegalZoom could probably work just fine. But the right answer really is sit down with someone who specializes in estate planning, right? Obviously, who's licensed in your home state, because one of the things that we've often run into is people will work with someone who is kind of a jack of all trades, an attorney who says, oh yeah, I do some estate planning, where we definitely want to recommend that you work with someone who that is their specialty, that they focus on estate planning and are up to date with all the estate laws in your home state. And then perhaps one of the most basic but also most important components of estate planning is your beneficiary designations. Now, you name beneficiaries on your 401k accounts, you name beneficiaries on your IRAs, you name beneficiaries on an annuity, and you obviously name beneficiaries on a life insurance policy, right? And so it's important to review and update those as needed. For example, we've seen cases in which an individual has been remarried but still has his or her ex-spouse listed as the beneficiary on their retirement and life insurance policies. And beneficiaries supersede your will. Another kind of misconception that we run into is folks will say, well, no, but my will says everything goes to my current wife. That doesn't really matter. If your beneficiary designations that are on file name someone else, that's what's gonna happen. So if you get married or divorced or have a child or there's a death in the family, those should all be kind of triggers to say, oh, we should make sure we review our beneficiary designation. And then another component to that is you want to think about naming beneficiaries and an important distinction between a per capita or a per stirpes designation. So I think the best way to explain that is through an example. So let's just say you named your son and daughter as equal beneficiaries, but only your daughter has children. So actually, let's just use me as an example. I'm going to reverse that. I have one sibling, an older sister. She does not have any children. I have 2 children, as I mentioned. And so if my parents said, hey, on their retirement accounts, right, they name each other as primary beneficiaries. And then they name my sister and I as equal contingent beneficiaries. But they may say, if my sister, their daughter, were to predecease them, would they want her 50% share to go to me or to any children she has? And in her case, there are no children, so it would go to me. Whereas if you look at, for me, if they name me as a per capita designation and I were to predecease them, then the share that was going to go to me would go to my sister. But if my parents said, well, actually, we would prefer it that my share go to my kids, then they would need to name me as a per stirpes designation. It's essentially Latin for by lineage. That's just an important, and they don't have to be the same, right? They could name my sister per capita and name me per stirpes. That's just another important thing that you want to review when looking at all your various beneficiary designations. So we're coming right up here on the hour. Wanted to be respectful of everybody's time. Like I said, we're going to send out these slides and a recording in the coming days. So thanks for all your time and attention and questions. And now I'm just going to put here on the slide real quick our contact info. Ours just has our names. I guess we don't have our contact info on there. But you can certainly reach out to any of us. My email address is jasond@AFS Financial Group, so feel free to send us a note. But all that contact info will be included in the follow-up summary email with the slides and audio. So thanks again. Have a great rest of your day, and hopefully get outside and enjoy this beautiful